So you're dreaming of a secure financial future, right? But the whole world of investing just feels, well, complicated, maybe even a little scary. Look, you are definitely not alone. Today, we're going to pull back the curtain on one of the most powerful tools out there for long-term growth, the ETF. And by the end of this, you'll have a clear roadmap to build a portfolio that actually works for you. Okay, let's get into it. This quote from John Bogle, who's basically the godfather of index investing, it changes everything. This isn't about trying to find some hidden gem of a stock or outsmarting the pros on Wall Street. Nope, it's about owning the entire market. Just imagine being a part owner of the world's most successful companies, all through one simple investment. That, right there, is the incredible power of an ETF.
So how do we actually own a piece of the market? Well, the answer is equities, stocks. These are the absolute bedrock of long-term wealth. Think of them as the engine that's going to power your portfolio's growth for years, even decades to come.
Imagine this for a second. With a single click, you're investing in Silicon Valley's latest innovations, Germany's manufacturing giants, and the booming markets across Asia. A world ETF makes you a truly global investor. You're basically buying a small slice of the entire world's economic engine. It's pretty much the simplest, broadest starting point you could ask for.
Okay, so here's the deal. On one hand, this is the ultimate set-it-and-forget-it strategy. It's unbelievably simple and diversified. But, and this is important, you have to get the flip side. Your returns are just going to mirror whatever the global market does. And you should know that market is often really, really heavy on the US, sometimes over 60%.
So here's what that looks like in the real world. You can see the ticker, ACWE, and check out those super low fees. But for our viewers in France, this next detail is huge. It's not eligible for a PEA. And since a PEA is a tax-advantaged account, that eligibility is a massive factor when you're choosing your ETFs. It can seriously impact your long-term returns.
And this is that aha moment, right? This is where investing just clicks for people. It's such a powerful mental shift when you realize you can go from being just a consumer of these amazing brands to being an owner. You're not just buying their products anymore, you're actually profiting from their success all over the globe.
Okay, so what if buying the entire world feels a little too broad? Or maybe you just want a bit more control over where your money's going. Well, you can narrow your focus. This next building block lets you concentrate just on developed countries. The world's most stable and mature economies.
So, what's the trade-off here? Well, you get the stability that comes with investing in corporate giants, those household names we all know and trust. The journey is usually a lot smoother. But the big question you have to ask yourself is this: are you willing to miss out on the potentially explosive growth happening in the world's emerging economies? And here's an example that's going to be really interesting for a lot of French investors. You'll notice the fees are a little higher, but look at that. It is eligible for a PEA. And that tax advantage, over the long run, it can make a massive difference to your bottom line, sometimes more than making up for slightly higher fees.
All right, if developed markets are the solid, stable foundation of your portfolio, then you can think of emerging markets as the rocket fuel. These are the economies that are just poised for explosive growth. We're talking about the potential global powerhouses of tomorrow.
But, and you knew there was a but coming, with all that potential comes a lot of risk. We're talking about a potential roller coaster ride here. There's way more volatility, political risks, currency swings, you name it. This is not for the faint of heart, for sure. But if you have a long time horizon and can stomach the bumps, it can be a really powerful growth driver. Okay, we've built our growth engine with stocks from around the world. Awesome. Now it's time to add some shock absorbers to the vehicle. Let's look at the other tools of diversification that can add stability and help protect your wealth when things get rocky.
First up, let's get this key concept down, the safe haven asset. Think about the last time there was a big market crisis. When stocks are plummeting, where does all the money go? Investors flee to assets they believe will hold their value, or maybe even go up. That is a safe haven asset in action.
For centuries, gold has been that financial security blanket. But here's the thing you got to remember. A bar of gold is kind of like a beautiful sculpture. You can admire it. Its value might go up, but it's never going to pay you rent or interest. It doesn't produce anything. You're just betting that its price will go up over time.
Next up is real estate. We've basically got two main ways to invest. REITs are like buying stock in a company that owns a huge portfolio of properties, super easy to buy and sell. SPIs, on the other hand, are more like being a direct landlord. They're harder to sell quickly, but they often offer more stability, which is exactly why the source author prefers them.
And then we have bonds, the real unsung heroes of a diversified portfolio. Think of a bond ETF as just a big collection of IOUs from governments and major corporations. You're the one doing the lending, and in return, they pay you regular interest. It's a steady, reliable income stream that can really smooth out the bumps when the stock market gets wild.
So we've covered the traditional building blocks: stocks, bonds, real estate, gold. Now, let's venture into a new and frankly wild frontier: cryptocurrencies. This is a completely different beast, with its own unique, mind-bending set of risks and rewards.
I mean, on one hand, the potential for truly life-changing gains is there. You can't deny it. But on the other hand, you're dealing with a level of volatility that can make your head spin. This is the Wild West of investing, and it's so important to understand you could lose everything. It is the absolute highest risk, highest reward corner of the investment universe.
And yeah, this reaction just perfectly captures the mood right now, doesn't it? Crypto isn't some niche thing for tech nerds anymore. It's totally mainstream, and new products are making it accessible to pretty much everyone. The barrier to entry has never been lower.
Okay, but here's a really important technical detail you need to know. A lot of these crypto products aren't actually true ETFs, they're ETPs, or exchange-traded products. Think of it this way. An ETF is like owning a tiny piece of the actual thing, while an ETP is more like a note that just promises to track the price. This can have pretty big tax implications, especially in France, so you've always got to read the fine print.
So we've got all our pieces on the table. We have equities for growth, bonds for stability, and maybe a little sprinkle of alternatives. The big question now is, how do we put it all together into a strategy that's actually going to help us reach our financial goals?
All right, let's boil this all down to the absolute essentials. First, ETFs just track an index. Simple. Second, your job is to pick the right index for your goals. Third, always pay attention to fees and taxes, like that PEA eligibility. And fourth, and this is the most important one, every asset has a purpose. You have to understand its role in your big picture plan.
I absolutely love this quote from Charlie Munger because it puts you right in the driver's seat. Look, we've given you the roadmap, we've shown you the tools, but at the end of the day, you are the architect of your own financial future. Now it's your turn to take these pieces and build something amazing. And that really brings us to the most important question of all. An ETF, your portfolio, it's just a vehicle. It's a tool to get you somewhere. The real question is, what's your destination? What do you want your life to look like in 10, 20, or 30 years? Start there. Start with that vision, and then build the portfolio that's going to take you there.